Following the Federal Reserve's recent rate cut, both the US dollar and Treasury yields have continued to rise significantly. CME rate futures now show that some traders are betting the Fed will hold off on cutting rates in November, with a probability of 9%. As I explained in my previous articles, the Fed's rate cuts primarily affect short-term interest rates, while long-term rates, such as the yield on long-term U.S. Treasuries, are driven by the strength of the U.S. economy. The Fed's rate cut has boosted economic growth, and stronger-than-expected U.S. non-farm employment and inflation data have fueled the rally in both the dollar and Treasury yields. So, will the Fed continue to cut rates? And will Treasury yields keep rising? Citing data from Bloomberg, a historical review shows that an increase in both 2-year and 10-year Treasury yields following Fed rate cuts is not uncommon. This occurred in both 1995 and 2008. The magnitude of the recent rise in Treasury yields is comparable to the increase seen after the Fed's 1995 rate cut, which led to a soft landing for the economy. In contrast, 2008 saw a hard landing, with Treasury yields also rising modestly after the rate cuts. If one were to take a simplistic view, it might appear that the U.S. economy is repeating the 1995 soft landing scenario. However, even though the economy landed softly in 1995, Treasury yields eventually fell as economic growth slowed. A slowing economy typically leads to a decline in Treasury yields, which would provide an opportunity for TLT to rise. Additionally, high interest rates have a dampening effect on the U.S. economy, and we are starting to see that impact. Low interest rates stimulate growth, while high rates suppress it. The likelihood of the U.S. economy thriving in a high-rate environment seems low, at least that's my personal view. Looking at the contrarian nature of the market, on August 2nd, when U.S. non-farm payrolls disappointed and unemployment unexpectedly rose, the market feared a hard landing, leading to a sharp drop in both the dollar and Treasury yields while TLT surged. Could the reverse scenario be unfolding now? The market is like a pendulum. Take October last year, when the 10-year Treasury yield reached 5% and the U.S. Treasury ramped up bond issuance. Treasury prices plummeted, and many were predicting a collapse in Treasuries. But 5% marked the peak, and TLT subsequently entered a bull market. At that time, the U.S. Treasury adjusted its debt issuance size and proportions. Prominent hedge funds that were short Treasuries closed their positions, and the Fed indicated that rising long-term Treasury yields could substitute for rate hikes. Rate hikes paused, and Treasuries rallied. Turning to U.S. equities, the current high-rate environment presents two possible outcomes. Higher risk-free rates depress valuations, leading to a decline in U.S. equities, particularly small-cap stocks tracked by the Russell 2000 index. Large-cap tech stocks, however, seem less sensitive to higher rates. This is evident from last October's history, when the 10-year Treasury yield hit 5%. Higher rates signal a strong economy, which could push U.S. equities higher. Large-cap tech stocks are more vulnerable to a recessionary scenario and falling rates. On one hand, large-cap tech has already surged significantly in a high-rate environment, so falling rates could lead to a pullback. On the other hand, lower rates would cause the dollar to depreciate and the yen to appreciate, weakening the positive effects of yen carry trades that have benefited large-cap tech. This was seen on August 5th when yen carry trades unwound, causing tech stocks to drop significantly in after-hours trading. In conclusion, I find the risk-reward profile of TLT and U.S. Treasuries to be attractive, as the probability of the U.S. economy gaining renewed strength seems low. Additionally, these positions could act as a hedge against large-cap tech holdings. This article is a personal record of my thoughts and does not constitute investment advice.